Uganda will grow at 5% this financial year, according to the International Monetary Fund's Regional Economic Outlook report. However, massive investment in infrastructure is not spurring the needed growth, which could be better than 5%. And in Uganda's case, holding back expenditure has artificially brought down the budget deficit.
What we saw is that the deficit this year was much lower than we had projected. So the deficit at 3.5% of GDP was way below the 6% that we had projected initially. And that mostly has to do again with the delays in implementing the infrastructure investments.
So in effect, once implementation goes on, the deficit will grow again, which under normal circumstances should be less. But several countries like Uganda continue to borrow heavily to build infrastructure, but with less growth. The IMF recommends cutting back some of the expenditure and perfect the already existing projects. This is called fiscal consolidation, which for some would be unwise in the current circumstance.
You have growth rates which is around 3%. You have aggregate demand which is low. You have import compression. You have situations where most of the growth is coming from the public sector. Should we go for fiscal consolidation? Are we going to rely on monetary policy for stimulating growth in a situation where credit growth is only 6%?
From the foregoing, government cannot cut back its expenditure. But then the question of growing debt continues, and the lack of other options to stimulate growth that puts money in people's pockets remains. Samuel Setumba, NTV Business.